welcome to our recorded discussion. So, I am your discussant for today, Professor Rebecca R. McKinney. So, our topic is all about mm, income taxation for corporate taxpayer. So, our learning objectives here is to identify and understand the classification of corporate taxpayer, learn and analyze the computation of income tax for corporation, partnership, and special corporation, and of course, comprehend and analyze the computation of improperly accumulated retained earnings. So we have three objectives. So first, let us define the terminologies used, so that we can understand income taxation for corporation. So corporation is an artificial being created by operation of law, having the right of succession and the power, attributes, and properties expressly authorized by law or incident to its existence. So this is according to the Corporation Code of the Philippines. So we have um, two classification of corporation. We have the domestic corporation and the foreign corporation. So when we say domestic corporation, it refers to a corporation organized under the Philippine tax law or the Philippine laws. And then we have the foreign corporation. It is a corporation organized under the laws of foreign country. So for foreign corporations, we have two resident and the non-resident foreign corporation. So a foreign corporation engaged in trade or business in the Philippines is called the resident foreign corporation. But those foreign corporations who are not engaged in trade or business in the Philippines but earn income from sources within the Philippines, they are called non-resident foreign corporation. So their income from the Philippines are coming from interest from the banks, dividends from different corporations, rents, royalties, and etc. We have also special corporations. So special corporation, it refers to a corporation, either domestic or foreign, subject to special tax rates as provided by the tax code. And we have also the GOCC, the government-owned or controlled corporation. These are corporations or agencies which are controlled by the government. And then another terminologies that we need to use here is the NCIT, the normal corporate income tax, which is 30% of the net taxable income. And we have also the minimum corporate income tax, which is 2% tax rate of the gross income applicable only on the fourth year of the business operation. So the corporate income tax liability shall be based on the NCIT of 30% or the MCIT of 2%, whichever is higher. So take note, this is the MCIT, whichever is higher, 30% or 2% of the MCIT, 2% of the gross income, or 30% of the net taxable income up to fourth year of business operation. Okay, so later we will discuss the detail of the MCIT. We have also the optional gross income tax or OGIT, which is 15% tax rate of the gross income allowed by the President upon the recommendation of the Secretary of Finance effective January 1, 2000. And then another terminologies that we need to use here is the improperly accumulated earnings tax or IAET. So this is equal to 10% of the improperly accumulated taxable income. This will be applied to every corporation. And then we have also another terminology, the partnership. Partnership is also part of the um, income taxation for corporation under taxation law because they have the same tax rates, okay? So partnership is a contract whereby two or more persons bind themselves to contribute money, property, or industry to a common fund with the intention of dividing the profits among themselves. We have also the general professional partnership. This is one formed by person for the sole purpose of exercising their common profession. And we have the general co-partnership. These are partnerships other than general professional partnership and considered corporations and are therefore taxed as corporation. General partnership, those in which each partner is personally liable to the partnership creditors if partnership assets are not sufficient to pay thereof. And then we have also limited partnership, those in which one partner is general partner and the remaining partners are limited partners and their obligation to creditors are limited to their capital contribution. Okay? So that's our terminology. So now let's begin. So first is, again, our topic is income taxation on corporation. So under the tax law or for tax purposes, under Section 22 of RA 8284, corporation include the following. Again, um, under only for tax purposes because partnership is the same, no, tax on the corporation. So the term corporation shall include the partnership, the joint stock companies, joint accounts, association, insurance company. So we have five considered as corporation under tax law. Partnerships, no matter how created or organized. Since partnership can be created whether just binding themselves or by law or just go to the SEC and register your partnership or by mere agreement with two or more persons that they will contribute money, property, or industry to a common fund with the intention of dividing the profits among themselves. That is already called partnership. So that's part of the corporation under tax law. Next is joint stock companies. So these are company or association consisting of individuals having a joint stock of capital represented by shares, organized to conduct a business for gain and having a joint stock of capital owned individually by the members and transferable without the consent of the group. We have also joint accounts. This is bank account in the name of two or more individuals, which is account owners who jointly share its affiliated rights and liability. They are still included in the corporation under tax law. Okay. Associations, they can be called a group of people who come together to achieve any particular purpose or goal and the two for a limited period of time. And we have also the insurance companies. These are business that provide coverage in the form of compensation resulting from loss, damages, injury, treatment, or hardship in exchange for premiums. So take note, this is under the corporation part of the tax law or part specific to tax purposes only. Okay? The corporation is not limited, does not include the following. So take note, the exclusion no, under tax for the purpose of taxation, these are not included as part of the corporation tax, okay? So we have the general professional partnership because this is part of the individual taxation, individual income earners because they are sharing the shares of the partnership and those shares would be included as part of the individual income tax, okay? And then a joint venture or consortium formed for the purpose of undertaking. They are not also included as part of corporation. Construction projects or engaging in petroleum, coal, geothermal, and other energy operations pursuant to an operating or consortium agreement under a service contract with the government. These four are not included as part of corporation for tax purposes. Okay, so again, I will gina-repeat yun ako na for tax purposes. Okay, these are not part of corporation. Okay, next. These are the classification of corporate taxpayers. So I discussed this on the definition of terms. So we have domestic and the foreign corporation. So under foreign corporation, we have the resident foreign and the non-resident foreign. So it's very important that you know how to classify like the individual taxpayers. So you need also to classify because they have different tax rates. Okay, and they have different treatment under taxation law. For domestic corporation, their income tax is 30% income tax, regular tax, no? Regular tax on the world income, meaning all income from within the Philippines and without the Philippines. So meaning abroad income, they are taxable 30%, okay, of their net income, meaning you will also deduct the expenses before you can go over to 30%. For resident foreign corporation, 30% regular tax on Philippine taxable income. So take note, only in the Philippines. And also for the non-resident foreign corporation, 30% final tax on the Philippine gross income. So final tax, just like the non-resident alien, but different yung rate natin on the non-resident alien. Here is 30% final tax on the Philippine gross income. Gross, so meaning gross sales, gross receipts. While the resident foreign corporation, 30% regular tax on the Philippine taxable income, meaning you will deduct all the deduction before you will proceed to the 30%. Okay. Domestic corporation, the resident foreign corporation, and the non-resident foreign corporation may be classified further into dalawa. First, ordinary corporation and special corporation. So for ordinary corporation, a corporation either domestic or foreign, which is subject to basis 30% NCIT or to the 2% MCIT rate. Okay? So 20%, 30% yung regular na income tax or the 2% based on the gross sale, whichever is higher. So take note of that. And then for special corporation, this is a corporation either domestic or foreign, which is subject to special tax rate as provided by the existing law. So they may be classified all the corporation either domestic, the resident foreign, and the non-resident foreign corporation. Okay, next. What are the exempt organizations? So the following organizations shall not be subject to income tax. So familiarize with this. This organization, they are not subject to income tax. So meaning they are exempt, no? Because they are not subject to income tax. So we have labor, agricultural or horticultural organization not organized principally for profit. They are not taxable. The mutual savings bank not having a capital stock represented by shares and cooperative bank without capital stock organized and operated for mutual purposes and without profit. Next, a beneficiary society, order, or association operating for the exclusive benefit of the members, such as a fraternal organization operating under a lodge system, or a mutual aid association, or a non-stock corporation organized by employees providing for the payment of life, sickness, accident, or other benefits exclusively to the members of such society, order, or association, or non-stock corporation, or their dependents. We have also cemetery company owned and operated exclusively for the benefits of its members, so they are not taxable. The non-stock corporation or association organized and operated exclusively for religious, charitable, scientific, athletic, cultural purposes, or the rehabilitation of veterans. Now, part of its net income or asset shall belong to or inure to the benefit of any member, organizer, officer, or any specific person. They are not taxable. Next, business league, chamber of commerce, or board of trade, not organized for profit and no part of the net income of which inures to the benefits of any private stockholders or individual. They are not taxable. Civil league or organization not organized for profit. So usually those corporation or organization not organized for profit but operated exclusively for the promotion of social welfare, they are not taxable. Next, a non-stock, a non-profit educational institution, they are not taxable. Non-stock, so take note of non-stock and non-profit. So meaning those who are stock corporation, they are taxable. But for non-stock and non-profit, they are not taxable. Government educational institution, they are not taxable. Farmers or other mutual typhoon or fire insurance company, mutual ditch or irrigation company, mutual or cooperative telephone company, or like organization of a purely local character, the income of which consists solely of assessments, dues, and fees collected from members for the sole purpose of meeting its expenses, and farmers, fruit growers, or like association organized and operated as a sales agent for the purpose of marketing the products of its members and turning back to them the proceeds of sales, less the necessary selling expenses on the basis of quantity produced finished by them. So those enumerated 11 non-taxable corporation or organization or association. However, sabi dito, no, the income of whatever kind and character of the foregoing organizations from any of their properties, real or personal, or from any of their activities conducted for profit, regardless of the disposition made of such income, shall be subject to income tax. Kung for profit na, kung any activities for profit, they are already subject to income tax. But for not profit, they are not taxable. Okay? So take note of the 11 organization. Familiarize this one. This is according to Section 30 of RA 8424. So 1, 2, until 11. So read this again. Next, domestic corporation. So again, we have ordinary corporation. Okay? These are the domestic corporations, so ordinary and special. So first is the ordinary corporation. The following taxes apply to ordinary corporation upon generation of income. So we have the final withholding tax based on the passive income and the capital gain tax on sale of land on or buildings in the Philippines. So take note of those final withholding tax passive income within the Philippines. So recall our previous lesson on the first week 1 to week 3. So read it again, no, on the final withholding tax on passive income. We have also the capital gain tax still on week 1 to week 3. No? Capital gain tax on sale of land and or buildings in the Philippines. This is final withholding tax of the ordinary corporation. We have also the capital gain tax on sale of shares of stock. So still again on week 1 to week 3. So balik yung tugbasahon, no, and then we have recorded discussion also there. So please view it again, no? Passive income, capital gains on sale, and capital gains tax on sales of shares of stock. Okay. And then, they are also taxable basic income tax, the normal corporate income tax, the 30%, or the minimum corporate income tax, which is 2% of the gross receipts or gross sales. Okay. So how to compute the final withholding tax on certain passive income within the Philippines? So our formula, passive income multiplied with the rate that is your final withholding tax. So we have different rates of the passive income. So please familiarize it or put some notes on it. No, memorize it. No, especially those who are accountancy, you need to memorize those percentage. No, the final withholding tax. So for interest here, this is in relation to corporation. We have also different rates on the individual, but there are several cases na magkapare-parehan, no? So for interest, final withholding tax, 20% for both short-term and long-term investments. So just base it on the interest income. How much is the interest income? Multiply it with the 20%. That is the final withholding tax of the corporation. Next, yield or any monetary benefit, 20%, deposit substitute, and trust fund and similar arrangement. So familiarize the rates, okay? Number 3, interest income from a depository bank under foreign currency deposit, that is 15%. But under yung mga local bank, that's 20% short-term and long-term. So familiarize the rates. How about for the interest income derived by a depository bank under the expanded foreign expanded foreign currency deposit system from foreign currency transactions. For non-residents, 0%, offshore banking units, 0, local commercial bank, 0, branches of foreign banks, 0, but for residents, 10%. Okay? Royalties, 20%. Dividends from another domestic corporation, 0%. So remember the rates, okay, for the interest. So ano ba yung i-remember natin? Usually 20, no? 20, but for the, ano na, ng expanded foreign currency deposit system, 15% na, no? Okay. Pero kung resident, 10. Depository bank under the expanded foreign currency transactions, no? Resident, 10%. So, number 3, number 4, tanawa na ninyo, balik na ninyo. Then, royalties, 20%. Dividends from another domestic corporations, 0%. So, let's look on our illustration. Just a corporation, this is a domestic corporation, has the following records of income expenses. So, meron siyang gross income. This is net already of 1% withholding tax. And then we have several expenses, no? Meron din siyang rent income. This is also net of 5% withholding tax. So, take note of mga net. Okay? Expenses on rent. Meron siyang dividends from domestic corporation. Meron siyang royalties. Meron siyang interest from bank deposit with PNB, gross tax. Gross tax. So, meaning, wala pa ilabot ang tax ana, no? Wala pa gi-withheld. So, the question here is the income tax and the final tax payable by JESA Corporation. So, let us first compute the income tax payable. So, from here, our gross income, 1,584, net pa man yan ng withholding tax. So, meaning add it back muna. Okay? Kasi magbe-base kasi tayo sa mga gross and then minus ang expenses. Kasi kung i-net mo na yan, understated na yung net income natin, no? So, meaning you add back the withholding tax. So, 1,584,000 divided by 99% to get the gross income. So, that is 1,600,000. Okay? Wag mo nang i-deduct ang expenses. All the gross receipts mo na. We have also the rent income, net of 5% withholding tax. So, add it back. Kasi kung hindi mo yan i-add it back, understated ang gross sales, no? Okay, so gross receipts. So, 137,750 divided by 95%. Bakit 95%? So, 100 minus 5%. Kasi yung rent, yung withholding is 5%. Okay? So, our rent income is 145,000. So, our total gross receipts is 1,745,000. Then, before you will less the deduction, yung mga deductions natin, expenses from the gross income, 755, and expenses on rent. Okay, 45,000. So, our total deduction is 800,000. So, 1,745,000 less the deduction. So, our taxable income now is 945,000. Okay, so tingnan natin. Ma'am, itong dividends from domestic corporation, this is subject for final withholding tax. How about royalty? Final withholding tax. Interest from bank deposit, final withholding tax. Kung final withholding tax, ang magbayad ana katong nag-withhold. No need for you to put it in your income taxable, no? Income. Dili na siya. So, only kinilang ang ating computation for the income tax. Okay? So, taxable income, 945,000. Using the normal corporate income tax rate, which is 30%. So, our income tax due there is 283,500. But take note, ipang less pa yung mga gipang withholding tax. No? I-credit natin yun. No? Kaya kung bayaran natin ito ng buo, nagbayad pa ng withholding tax, so sobra ang binayad natin sa BIR. So, you need to less the withholding tax kaya nabayad na yan sa BIR kung nag-withhold ana. No? So, compute. Here, 1% kasi yung withheld. So, that is 1% of 1,600,000. So, 16,000. Yung isa naman is 5% yung withheld sa rent income, no? So, 5% of 145,000, that is 7,250. So, yung withholding tax natin lahat is 23,250. So, deduct it. So, our income tax payable now is 200,000, 260,250. How about the final tax? So, yung mga final tax, yung mga galing from the passive income. So, we have royalty, which is 80, royalty natin dito is 80,000, no? Times 20% and also the interest, no? Which is 20%. Ma'am, how about the dividends from domestic corporation 35? Recall, dividends from domestic corporation is 0%. So, no need for you to compute it. So, your total final tax payable is 20,000. So, kaya kailangan talaga i-familiarize ito, no? Yung mga rates, no? So, interest, this one. Oh, tanawa na ninyo. Balikan na ninyo tanaw, ha? Okay. Balikon itong mga passive income. Next, capital gain tax on sale of land or buildings. Kasi kasali din siya, mga taxation ng corporation, no? So anyway, this was also discussed in your previous lessons from week 1 to week 3. So our requisite here is the land and or building must be a capital asset. So recall, capital asset and ordinary asset. Yung ordinary asset yung ginamit sa business, but for capital asset, hindi, no? So, and it must be located in the Philippines. So our formula is 6% of your tax base. So your tax base, whichever is higher with the price, market value, or the zonal value. So multiply it with 6%. So let's have the illustration. Miss Jessie C is not engaged in real estate business. Kaya dili man siya engaged, so meaning to say kung makabaligya siya, dili siya ordinary asset, no? Kasi kung real estate business siya, yung baligya niya when he sold land, ordinary asset na. Pero this one is not a real estate business. So this is capital asset. So he sold 1,000 square meter residential land for 2,500,000. So compare the selling price, the market value, 2 million, zonal value is 2,1, whichever is higher between the three. So yung higher natin dito is, napa ba? Ay, tingnan natin ha. Fair market value is 2,500,000. 2 million, residential lot, 2,500,000, zonal value is 2,1. The land was acquired by purchase on February 3, 2010. After acquisition, the land was fenced at a cost of 80,000. The commission of 5% of the sales price was paid to the sales agent. So, dapat manggod whichever is higher. Saan ba yung 3 million? Na mali ito, no? So, dapat this one is whichever is higher. 2,500,000, market value 2 million, and zonal value. So, ang higher dito is, dapat this is 2,500,000. No? 2,500,000 times 6%. How much? So, just correct it na lang, no? Tingnan natin, ha? Let us correct this, no? See, whichever is higher, 2,500,000 times 0.06. So, that is 150,000 ang capital gain tax due. Dili 180. Balik na mali ni ito ha, na mali class. So please ano na, just cash it out, put it 2,500,000 kasi walang 3 million dito, no? Whichever is higher man, the selling price 2,500,000, market value is 2 million, zonal value is 2,100,000. So ang higher na the selling price which is 2,500,000 multiply with 6%. So dapat ang answer is 150,000. Okay? Ang question is on the capital gain tax, no? So, hindi na yung after acquisition, the land, wala na siya. The land was fenced at the cost of 80. No need na. Okay? And also yung commission. Kasi magbe-base talaga tayo on the tax base natin, the price, market value, and the zonal value. Okay? So, okay, doon muna tayo. And then, next ulit sa ating discussion, no? Next recorded discussion.